little or none of your own cash. I'm Gordon Bizarre, and today we're going to talk about asset-based lenders, what they finance, where to find them, get the money, close the deal. And here's what you will learn from this webinar today. Asset-based lenders, what they finance, and where to find them, how to properly qualify your asset-based loan so you can get it, how to navigate the lender's skin in the game rule. Now, you all know what that rule is because you've gone to lenders and you try to put your no cash deal together. And the lender says, look, you don't have any skin in the game. You're not taking any risk. We're taking all the risk and they won't loan you the money. So we're going to show you how to navigate that skin in the game rule today, how to make the double escrow technique work for you, how to use bridge loans and transaction loans to complete your financing. And number 6, how to keep shopping for credit, multiple inquiries from lowering your credit score. A lot of folks are afraid to go out there and ask too many times for these lenders to look at you as whether you're credit worthy or not. And so these multiple inquiries, people are worried that they're going to reduce their credit score. So we're going to address all these issues today so that you can confidently go into the marketplace when you've got your company ready to finance and just get it done. Type your questions and comments into the question box on the right side panel. I love it when people raise their hands because it gives me a chance to actually talk to real folks and tease out of them, if you will, the real elements of the question and then get to the real elements of the answer because it's a little bit of give and take and it works better. We don't get to your question today, no problem. Just send me your question at bizarrefinancing.com and more than happy to answer it. And in a lot of cases, those questions serve as great opportunities for me to build out our presentations to you, which already has answers to the questions in it. So just want you to know they're helpful to me when you do right. All right, today's session, asset-based lender financing. And it's frankly all about playing by the rules. If you've ever gone to a bank or to an asset-based lender, it becomes abundantly clear right away that they have a set of rules and processes and procedures and all that kind of stuff that is going to determine whether or not they make a loan. And even if they make the loan, how it's going to get handled and validated all the way through that process. So they're rules-based folks. And it doesn't do you any good to ignore their rules. What you want to do is understand their rules and understand how to make their rules work for you. So that's what we're going to do today. So asset-based lenders have 2 different sets of rules for lending money to businesses, 2 separate sets of rules. One set of rules pertains to financing an existing owner and their business, okay? An existing owner and their business entity for additional working capital. So I already own a business, I go to an asset-based lender, or I got assets, machinery and equipment, accounts receivable, maybe even some real estate, lots of different assets. And I want to finance them and I need more working capital. That's one set of rules. And this is what an asset-based lender does when you own a business. And these rules are primarily based on the value of the assets, which will serve as the collateral for the loan. So the asset-based lender isn't interested in your credit worthiness so much. They're not interested in what the assets look like. They're interested in how much money they can get for those assets, since they're going to have them as collateral for the loan if they have to sell them to get repaid back. That's their primary worry. And in financing a business, frankly, it's their only real worry. But things are going to change here in a little bit in a moment, because the second set of rules applies to financing the acquisition. So now we're going to have some different rules other than the simple go to the asset-based lender, show them your assets, they'll do an appraisal on them, whatever they're worth, they'll loan you some level of that, 60, 70, 80% sometimes of what those assets are worth. And if you don't pay them, they don't worry about it. They're going to come in, scarf up their collateral, they'll be repaid. And yes, they take some risks. Yes, it's a process, but they've already got built into their interest rates and their security agreements, everything it needs to protect them and ensure that they're going to make money. So that's where they are there. But when you come in to buy a business, these different set of rules are going to apply. Now, these rules are essentially the same, except the lender insists that a certain percentage of the acquisition price, usually around 10% or more, comes from the buyer's personal funds. Now, why is that important to them? The purpose of this rule is to ensure the buyer has a personal investment in the acquisition, also known as in the game. The lender doesn't want to be the only party taking the risk. They want to know that you've got up money up in front of them, that you're going to have to lose your money before they even begin to lose their money, so that you've got skin in the game, and that skin in the game is going to cause you to work harder, be more prolific in what you do, bring out the very best fighter in you to make sure that you survive and can repay them because you're going to lose your money first. So that's their mindset. That's where they're coming from with this. And that's why it's so important. And frankly, lenders have found that when borrowers share the risk, they found that in the times that buyer didn't have skin in the game, when the going got tough, they got running. And all of a sudden, they had this colossal amount of collateral, hopefully, that may have got misspent, misappropriated. The buyer ran to South America or wherever they went to. They couldn't find them. They have assets all over the place. They can't even locate them, and they got to go figure out how to go find their collateral and hopefully get their money back. So the lenders over time learn that they can't do this without having a borrower with skin in the game. Now, if you own the business already, you have skin in the game because they're not going to loan you 100% of the financing. So the part that they're not loaning you is your skin in the game. That's what you've built up in that business. You worked hard to put it there. And so you don't want to lose that. So you have the skin in the game. But when you're the buyer, the only way you have skin in the game in their mind is for you to put up a certain proportion of the purchase price. They'll finance the rest through the asset-based loan, but they want to know you're in front of them. Now, there are 3 solutions to skin in the game rule. Okay, so here's the skin in the game rule. You got to have it. All right, now how do they do this or how do they enforce this? And then what are the solutions to this? And there are 3 of them, and I'm going to take you through all 3 of them. In all cases, you establish a special purpose entity, they're called SPEs, to be the buyer, which typically is a limited liability company. Okay, so now expunge from your mind that you personally are going to buy this company. It's not going to happen that way. You're going to personally establish a limited liability company. The limited liability company will be the buyer. You own the limited liability company, so you're going to end up owning the business because you own the company that owns the business. So you're going to still be the owner, but now it's not you personally that's making the purchase. It's the limited liability company that you own. I know I said that a couple of times, different ways. I just want to make sure everybody understands the nuance here. You are not the buyer. It's your company that you formed that is the buyer. All right. Now, solution 1, because remember, this is true for every one of these 3 solutions. You're going to form this SPE. All right. So solution 1, you have and provide your own skin in the game money. That doesn't sound very bizarre financing or creative, but it's certainly a solution. You have the money. You don't mind putting some skin in the game. And so you do it. Okay. And you provide the skin in the game funds and can choose to leave it in the LLC, your company, for additional working capital or reimburse yourself after the acquisition is closed. Okay. So not very creative, but it's a solution. Let's look at solution number 2. An investor provides the required funds. Okay. So what you've done in the purchase of this company, you've evaluated it, right? You know how profitable it is and how much money it's making. You can see from the amount of profit and cash flow that the company has that all of this debt you're creating is not only going to be collateralized in full for the debt that you're going to incur, but that your cash flow in the business is going to easily enable you to amortize that debt and pay it off and make surplus profits in the company. And if it's not true, you shouldn't be buying the company. So that should be true of it. So you don't have the money. So what you do is you figure out, of my surplus profit, what could I pay to an investor who will provide the skin in the game money, not to me, the skin in the game money to my LLC, because who is the lender going to be looking at for skin in the game money? They're not looking at you personally. They're looking at the buyer. The buyer is your LLC. The lender doesn't know whose money got into the LLC that's putting the skin in the game, but all they know is they got skin in the game. It came from your investor. You gave them either a piece of your company, meaning equity in your company. You gave them some method of getting their cash back, either as the form of a royalty that they earn because they put up the money. You give them a repayment plan for the money, but they still keep a portion of the equity. You've come up with some plan to make your investor a very happy person, and that solves your skin in the game problem. So the investor contributes the necessary skin in the game money as an investment into your LLC. Problem solved, right? Problem solved. The investor can be repaid after the acquisition with a profit or remain a minority owner of your LLC. Any combination of different methods that you learn in bizarre financing can be used to make your investor very happy, but problem solved. Okay, solution number 3. And this is the one that we're trying to make sure that you understand today, because this is the one that really is creative in the sense of how it gets you around the issue. But solution number 3 is to artfully navigate the asset-based lender's skin in the game rule. All right. So the rule is going to be there. This is what the lender is going to be looking for, but we're going to be artful in how we navigate that rule. And here's how we're going to do it. You do not seek financing or the acquisition from the asset-based lender. You don't do that. Okay. You never talk acquisition money when you're talking to that lender. Instead, you approach the asset-based lender to finance the assets of the business post acquisition. In other words, Mr. Lender, I'm going to be buying this company. And once I've purchased it, this is what my asset structure is going to look like. These are the assets I will own. This is the income I will have. And I want to know if you will finance me with an asset-based loan of X amount after I've acquired the company. The magic words there are after I acquired the company. So the lender is now not thinking rule set number 2, that they're loaning you the money to buy the company. They're thinking rule set number 1, which is you're going to be the owner. So whatever the assets are worth, we can loan you the money based on the assets. And that's the only qualification we really need to be concerned about. So all conversations with the lender discuss only funding once you own the business. Now you've got to get that mindset clear, because everything you language to that lender is language from the place of after I'm the owner. Okay. And you don't want to slip up. So you got to get this really well into your head that you only talk in language in terms of after the purchase. All right. This approach exempts you from the skin in the game rule, because now they don't look to you to put skin in the game. They assume you're already the owner now and that you'll have skin in the game. You request permission from the seller to allow your lenders to inspect the company's assets as part of your and your lender's due diligence process. Because in order to get your loan closed, even though the other owner is sitting there owning the business, okay, that's not going to be a question now, because they know you're going to buy the business, but they're not loaning the money till afterwards. But they still got to know before they commit to the loan, what are these assets? They may have to have one of their auctioneers go into the building, and they use what's called a clicker to go asset by asset and click in $100 units what they think those assets are worth in the liquidation markets or whatever market valuations they're going to use. So they got to do all that stuff. They got to see the condition of the assets. They have to do all that, but it's not a problem, because your seller knows you've got to inspect these assets. Your seller knows your lenders have to inspect these assets. And this sets the opening for all this to get done while the seller is still the owner of the business. You establish a double escrow, and then you go into our Bizarre Financing Essentials materials. It tells you exactly how to set up the double escrow, as explained in the Bizarre Financing Essentials training, so that the asset-based lender grants the loan, and here in quotation marks, after your LLC owns the business and its assets. Now remember, we're going to use simultaneously closing escrows. When they simultaneously close, your documents that you sign for loans and all of that stuff to the asset-based lender, that all gets transmitted to them as you own the business. So the closing is legitimately happening, where your documents are being delivered to all of the various parties after the closing, including they get their money. The seller gets his money after the closing. All right. So this is how that all comes together. You complete the necessary paperwork with the lender as if your LLC is already the owner of the to-be-acquired business. So all the paperwork sitting in the escrow is all signed as of the date of the close. All right. So that's all done. It's all signed. It's all ready to be delivered to every party that's appropriate. All agreements are dated as of the closing day and signed by the new business owner. And remember, it's not you. It's your LLC. You'll sign it, but it'll be as manager of my LLC, or it'll be as president of the LLC, or it'll be as something, title of the LLC. It's not you personally that's signing for this as of the closing date. The funds, agreements, and other closing documents are distributed to the parties according to the escrow instructions for both simultaneous closing escrows. Okay. Now, if you've gone through the Bizarre Financing Essentials training, you should be pretty comfortable with this information here, because you've already had a very good explanation of it really within that training itself. Okay. In lieu of a double escrow, use a bridge or transaction loan. Now, these could be used with a double escrow, independently of a double escrow, but I want to make sure you know what both of these are and how they work to help you to get your asset-based loan. Transaction loans are typically paid back instantly. Okay, so what's a transaction loan? There are people, which if you go into the research center of Bizarre Financing, you have access to that, where you can go into our research center and you can look up transaction lenders, okay? And so that'll help you to know who they are and how to reach them. But here's what they do. They look at your deal and they say, look, we don't mind putting up the money for this because we have the cash. We physically have cash, but we don't want to take any risk. We want to just make money on the fact that we have money available. It's a way we leverage our funds to make more money. We'll look at your deal, but it's got to be structured so that the minute we make the loan, we get our money back instantly. We don't want to take any risk. will charge you 1.5% for the money, 2% for the money, 3% for the money, depending on how complex your deal is and what hurdles they have to get over in order to get the deal papered and looking the way they need it to look for their comfort. But they're going to charge you a fee for this. And at the end of the day, money will appear at a bank, 3 million, 5 million, 10 million, whatever amount of money you need will appear at the bank. The bank uses the money to close the deal, but the deal closes through the double escrow and they get the money right back and pay it right back to the transaction lender. But this enables you to look to all the world like you have put your own money in the deal because real money is going to flow through those accounts. Okay. The transaction lender isn't going to take any risks. They're happy to do it. They make their premium. They were never out their money for a minute. So it's like making money on nothing to them. They just happen to have money, and it's the way they make more money on the money that they have. Simple business transaction for them. So that's a transaction loan, and it's instantaneous. Then there are bridge loans. They may be paid back instantaneously, like a transaction loan, or up to several months later with good credit. So let's say your LLC has good credit. Maybe you brought in an investor for part of the money, but you don't have it all from the investor. And so now you're going to a bank and you're getting a bridge loan, but they're looking at your LLC. They see its worthiness with credit. They see an equity value in the LLC, which was put up by your investor. So whatever that picture looks like, you can then get qualified for a bridge loan with the bank, and they may want to be paid back instantaneously, all cool, or they may give you a couple of months to pay it back, enabling this to not have to even go through a double escrow because you can buy the business, you have the bridge loan, you're funded to do it. Then you go out, you start making profits, you start refinancing a few of the assets and whatever else that you're going to do. And now you have the money to pay back the bridge loan from your asset-based loan, right? Because you get the asset-based loan really, truly after your closing because you use the bridge loan to close your deal. Now, I know I'm talking a little fast here. Just remember, this is all recorded. And so you're going to have the ability to go back and listen to this over and over again. And if you have the kind of player that'll slow me down, you're going to listen to me at a lower voice as you slow me down, but it'll all hopefully be clear. Okay, apply for these loans as soon as you are confident that you qualify for the asset-based loan. A lot of times people ask me, when do I apply for the loan? Do I apply for these other loans first or the asset-based loan further? Don't worry about that. It's a really simple process. All you want to know is the key loan is your asset-based loan, right? That's the loan that lets you permanently now own the business. Everything else is temporary, okay? So you just want to know you can qualify for that permanent funding, whatever amount it is that you need, and then you go for your other financings, your closing financing, your transactional or your bridge loan. You go for those after you've secured or gotten your commitment relative to your asset-based loan. So now you got one, and then you can quickly put together the others once you got your asset-based loan in place. Now, a lot of questions, by the way, that I've gotten before today, I'm trying to address those. That's what you mentioned earlier. It's great when you ask questions because I know what your blocks are, what's concerning you. And one of those concerns is about hard inquiries lowering people's credit scores. Everybody's afraid, gee, if I apply too many times for credit and trying to find the right lender and all that stuff, it's going to adversely affect my credit. Okay. And if you're concerned, don't be. Okay. And here's why. It is your LLC that is applying for the loans, not you personally. You are not personally applying for any loans here. And any lender wanting to know your credit background, and then the only reason they want to know that because they know you're not applying for the loan is they do want maybe your personal guarantee. So they do care about your credit, but at the very least, they want to know, are you an upstanding person? Do you pay back money when you owe it? Are you a flaky person that they shouldn't even be thinking of loaning money to? They want to know your credit background, but they cannot pull a report as if you are personally requesting more credit. They can pull a background report, but they can't label it that you're applying for credit, which means that the credit reporting bureaus do not hold that against you as if you were getting those inquiries because you're applying for credit. So it does not affect your personal credit score. So please understand that's just the mechanics of how those things work. And even when you're seeking personal financing, credit reporting agencies understand shopping for better rates and terms. And any inquiries that show within a 3-week period show as one inquiry. So they'll show your increase, but you'll have maybe 3, 4, 5, 6 of them, but they'll all show and affect your credit risk score as if they were one inquiry. It's an important concept to understand, and hopefully it'll relieve your fear about, wow, all this shopping around for credit's going to make me look terrible on my credit score. Doesn't happen that way. So if this sounds like something you would like some help with, if this sounds like something that can make the difference for you, What you're going to want to do is learn more about our partners in business acquisition, and you're going to identify how we're able to help you buy 8 and 9 figure businesses and do it using financial leverage through our done for you service. And so somewhere on your screen there ought to be a button that says, if you want more information, press this button and it'll put you in touch with one of our team members who will make sure you have a full understanding of what we do, how we do it, and what it can mean to you and your ability to create financial wealth.